Hello, friends. How are you doing? I hope you're doing very well and you're finding some value in this lecture. Again, hang on tight. We are nearing we are nearing the end of the lecture, and we're getting to not so much technical topics again, but now psychological topics and sort of mental things you must understand mentally. Very, very, very important topics now. Very, very, very important. So, welcome to today's lecture, and as always, grab your pen and your notebook and let's get started. Today's lecture is on risk management. I'm hoping some of you have heard about risk management before. I'm hoping you have practiced it in some regard, in some other things that you've done, and I'm hoping you understand the general concept of what managing risk is all about. Risk management is the process of identifying, limiting, and controlling potential losses in your trades. It ensures that even when you lose, and yes, you will lose sometimes, if, in fact, you will lose many times if you're just starting out, you will lose a lot. Losing in trading, especially in your beginning days, is like falling back on the ground when a baby starts walking. A baby doesn't just stand up and walk. It stands, falls, stands up until he figures it out. He figures it out by doing so many things. If you have parents, supportive parents, or people around you, they assist with different things. Some will hold your hand and walk with you. Some will put you in a walker. All manner of things. But the point is that when a baby tries to start walking, a baby would fall and start again, would fall and try again. So risk management can be seen as not allowing a baby try to start walking on the rails or on the stairs rather, or putting a baby in a walker. That's risk management. Ensure that it doesn't fall and hit its head or something like that. Anything that prevents a catastrophic outcome is said to prevent risk. It ensures that when you lose, which you will lose sometimes, the damage is minimal and recoverable. In simple terms, risk management is equal to capital protection. In trading and as many other endeavors in life, your base or fundamental value is always expected to be protected. For instance, if someone is a bungee jumper, or if one is a bungee jumper, or you're a mountain climber, or something like that, the most important thing is not getting to the top of the mountain. While that might be the goal, say you want to climb Everest, while climbing Everest might be your goal, or while jumping down from a spaceship to the Pacific Ocean, extreme sport events, or gliding through the Swiss Alps can be your goal. If a scenario occurred and you were unable to meet that goal, and you had to choose between meeting that goal by all means or losing your life, I expect that most people would choose, you know what, I'll just keep my life. I can try again. That is what it's all about. Even in situations where you cannot meet your goal, provided you can keep your life, keep protect something that is of ultimate value, you can always try again. So risk management is all about capital protection. You have some base capital, 100,000, $50,000. Risk management is ensuring that worst case scenario, I have my capital back. I mean, it may not be exactly the amount, but you lose a manageable sum and you have a reasonable amount back. That's what risk management is all about. It's all about capital protection, it's all about value protection. It's not about making profit. Again, it is not about making profit, it's about preserving your life when you go mountain climbing. That is what it's about. So, key components of risk management: one is risk per trade. This refers to how much of your account you are willing to lose on a single trade. So, on a single trade, there is a certain or a specific amount of money that you should plan to lose. It should not be random, it should not be unknown, you should not just enter lot sizes, which is why you see these lectures are building upon themselves. I've talked about lot sizes, I've talked about tools that you can use to calculate your lots per trade in correlation with your risk per trade, in correlation with the percentage you're planning to risk on an account. So these are very important and they are building on themselves for this specific reason. So risk per trade is how much you're willing to lose on a certain trade. You have $10,000 and you're just starting out. You may decide to just lose $1 per trade, to risk $1 per trade because you're just starting out. It doesn't matter. $10,000 is what you can afford to risk. It doesn't matter, and you're risking $1 per trade. You just want to see how the market is, how it moves. It's reasonable. Then when you become a little bit more advanced, then you can go to risking 1% of that account, 0.5%, 0.25, a quarter percent of your account. Risking $25, risking 50, risking 10, $100, risking 1%. And some more advanced traders risk even more. But no matter how advanced you are, I have not really seen a trader who is risking 50% of their account, who is risking 100%, 80%, 70%. Those are extreme values, So I've seen advanced traders do as much as 10%, but this is advanced many, many years. In fact, maybe 5, 7, almost 10 years in the market. And then, and even with this, they are done this exponential risk. They are done on accounts that can be afforded to be lost. They are done on capital that even if they lost it, it doesn't matter. They're not done on main capital. So usually main capital is 1%, 2%, max 3%. It's very conservative, very responsible trading. So professional traders usually risk between 1 to 2% of their capital. Example is if you have $1,000 and you risk 2%, your maximum loss should be $20. That means your stop loss must be placed at the level where the dollar loss equals $20. And you must also factor in commission if you have commission on that brokerage account. Remember the topic on brokers. So if you have brokerage fees, if there are commissions, you should factor that in as well. Sometimes you may slip a little bit, it may end up being like $21, $22. Sometimes you may just be a little bit perfect, it may be 19.8. So you need to factor in commissions and fees as well. So again, risk management is the process of identification, analysis, and acceptance or mitigation of uncertainty in investment decisions. Key components of risk management, we have stop loss and take profits. So stop loss is the level where you automatically exit if price goes against you. This prevents emotional decision making. And take profit is the level where you automatically close your trade to lock in gains. So stop loss is a point of invalidation. I think I've mentioned this before. And it's a stop loss when you place it and it automatically exits you from the market. People do something called a mental stop loss. You are watching the market. When it gets to 20, I'll close it. That's not advisable. That's not reasonable. That's not professional. Put in an automatic order to exit you from the market. Then we have TP levels. Something is through experience, through all these years of experience, I can tell you that setting your take profit level is harder than setting your stop loss, because how do you even know where to exit? How do you know if not to hold it on to $2,000, or take it at 1,005? So at first, in the beginning, a predetermined take profit level or a risk to reward level is very advisable. 1:3. If you're risking one, you're trying to make three. Again, in the beginning, you're not trying to make money. I know it sounds counterintuitive, but this is the truth. You're trying to build consistency, you're trying to build habits, you're trying to build discipline, you're trying to allow your skills marinate. You're trying to allow everything you learn become a part of you. So purpose of this is to ensure consistency and avoid impulsive exits. So risk to reward ratio, this measures how much you stand to gain relative to how much you risk. So risk the formula of risk to reward is potential profit over potential loss. So that's where the 1:1, 1:2 comes in. So if you are risking one, you're trying to make three. If you're risking $50, you're trying to make 150. If you're risking 10, you're trying to make $30. If you're risking $1,500, you're trying to make $4,500, and so on and so forth. So example is if you risk $10, you're trying to make 30, which is a 1:3 risk to reward. It could be higher, it could be lower, it could be 1:1. Some people have something called a negative risk to reward. Some people have exponential risk to reward, 1:10, 1:15. You will find your place as you practice and as you keep on studying. So that means if you win 3 out of 10 trades, you can still be profitable. Yes, with the 1:3 risk to reward, if you win 3 out of 10 trades, you can still be profitable at the end of the day. So you need just about the 30% win ratio. So risk to reward and win ratio complement themselves such that if you have a high risk to reward, you can survive a low win ratio. I know at first you want everything to be high, 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 but experience and stats have proved us that it doesn't really matter. The most profitable traders in the world have not really had high risk reward and high win ratios. We've had some of them that had very low win ratios and extremely high risk to reward. We've had some that had manageable win ratios, 30%, 25%, and just about average risk to reward. So it again, these are the things that you will find yourself. You will you'll come to a conclusion as you study and as you practice. So an ideal risk to reward ratio is 1:2. So another component of risk management is position sizing. This determines how large or how small your trade should be based on your risk percentage or stop loss distance. Again, remember the tools I mentioned, trading tools and softwares. We have my FX book, we have baby pips. This can be used to help you calculate your risk per trade. So position sizing is okay, look, how much lot size am I putting on this trade? And it's all correlated. The lot size you put on a trade should be related to the amount of money you're trying to lose on that trade, and how much percentage is that amount on your capital. So all of this is seriously interwoven. So using a position size calculator makes things easier and prevents over leveraging. So this is one of those places where by all means use technology. By all means use a calculator. By all means use the free tools that are available. There's no reason to overstress it. There's no reason to manually calculate it. Just use a size calculator and get an accurate size to enter your trading. So leverage, again, you have studied I've explained, again, I have explained what leverage is in the previous lectures. So leverage allows you to control larger positions with smaller capital, while it increases profits and also magnifies losses. So it is being repeated here because if we're talking about risk management, you must understand leverage. So leverage, while it helps you make more money, it can also seriously magnify your losses. So, in the bid to manage risk, you must understand that you are not expected to fully leverage your account or fully take advantage of the leverage that your account provides. So, drawdown represents the percentage decline from your account's highest point to its lowest point after losses. Say you have $10,000 and you take a couple of losses, you are risking $10 per trade, which is 1%, and you take four losses, which means you've lost $40. Actually, it should be less than that if you are using compound interest, which is if you are calculating the loss based on your balance. But let's say you take $10 losses four times, so that's $40 loss. Your account balance is now at 9,900, and it's now $960. In this case, you have suffered a drawdown of $40 from your initial capital, because remember, your your C level, the base level of your capital was $1,000, and now you have gone below $1,000 to $960. So that is a drawdown, it's just like a pulling down of your account. It's natural, it's completely okay to have a drawdown. Don't overthink it, don't get scared, don't be bothered. Drawdowns are a part of this business. Even when you're in profit, you suffer drawdowns. So because you can make $500 and lose $100, in that case you've suffered a drawdown of $100. So it's a completely natural thing. And in fact, drawdowns are very good. The quicker you know how to survive drawdowns, the quicker you become profitable, as funny as it sounds. So drawdown is such that the if you suffer losses early enough and you are able to maneuver your way around those losses without exponentially exposing your account, congratulations, you are almost there, because drawdowns teach you the best lessons. That's just the truth. The losses will teach you the best lessons. They will teach you how to be responsible, how to be patient. They will teach you everything about your psychology. It's very, very it's a wonderful place to be, as counterintuitive as that is. Being in a drawdown is a very wonderful place to be for your journey. So example is, if your account grows to $2,000 and it drops to 1,006, again you have suffered a 20% drawdown, which represents $400. So the goal is keep drawdowns below 10 to 15%, to stay emotionally and financially stable. So if your drawdown goes exponentially low, 20, 30%, usually it affects your emotions. But again, if it goes that low and you are able to get yourself back, congratulations, you have literally crossed half of the hurdles in your trading journey. So money management refers to how you allocate money, how you allocate, preserve, and grow your capital over time. It's the discipline of planning how much to trade, how much to withdraw, and how to compound profits wisely. So, money management is different from risk management in that risk management is you have a capital in your account. Risk management is how much you risk per trade, how much you lose, what you do after you lose. Am I cutting my losses short? Am I what's my stop loss? So that's what risk management is. But money management goes beyond that, because money management is, okay, look, if I make profits, how do I withdraw profit? Am I compounding? Am I trying to? So you have $10,000, you make $5,000. So how would you withdraw? Are you withdrawing the $5,000? Are you withdrawing three, then turning the $2,000 to adding it to your base capital, such that over a period of time your capital is also increasing while you're making profit? So you see that this one is a more complex topic. It also involves your losses. So if I lose, what am I to do? Should I withdraw? So you can have $5,000 in an account and you lose 20%, so $1,000, and you can decide to withdraw $2,000 of it and leave $2,000 in the account. So this is what money management is: how you manage the money you have. It's not just a risk now, it's not just a trade. How you manage your profits if you make profits, and how you manage your account when you take losses. So it's a more holistic topic. It involves risk management as well, but it's more holistic and involves everything around the capital in your account. So it's the discipline of planning how much you trade, how much to trade, how much to withdraw, and how to compound profits wisely. So the principles of money management is, again, first and foremost, protect your life if you are mountain climbing. So the first thing is protect your capital. Your first goal is not to make money, is to avoid losing it unnecessarily. Because if you are alive, if your legs are okay, if your hands are okay, if you don't get to Everest, if you don't get to the peak of Everest today, someday you will. That's what I want you to remember. If you don't make the $200 today or $500 today, someday you will. Protect your capital. That is the most important thing. If there's anything you want to pick from this lecture, protect your capital like you protect your life. Protect your capital like you protect your car. It's not reasonable to drive somewhere, and you want your car is all bashed up and destroyed, and you say, as long as I got here. No, I don't think anybody who drives want that. As much as possible, they want their car to be in the safest condition possible. Nobody wants to give away such nobody wants to exchange such value for just the sake of arrival, an arrival that you can still arrive. It's such that you can always still make the profits. Why not just protect your capital? Again, you can always climb Everest again. So why not just protect your life? So trade only with risk capital. That is, if you have $1 million, or if you have $100,000, all the money you've saved over the years in investments, interest, gifts, inheritance, you have $100,000. It is not all your assets. It is not advisable to put all of that in a trading account. You can lose the money. So it is advisable. Okay, look, what portion? Because if you say, for instance, you're a salary earner and you make $5,000 a month. In $5,000 a month, no salary earner is putting the $5,000 into an investment. There's always, again, we'll go back to the topic of money management. There's always, okay, look, I'm going to pay bills with this. I'm going to invest this. I'm going to save this. So take a portion of what you have that you can afford to lose. If it goes to zero, you have $5,000. You can afford to invest $1,000, and you put $1,000 in the market. And if you lose $1,000, it's okay. I can always try again. So always invest with risk capital. Use money you can afford to lose. Trading with rent or tuition money leads to emotional pressure and poor decisions. Yes, people have done it, but until you do it, you haven't. So the advice is not to try, but some of you will, and some of you will succeed. But the truth is, most will not. So compound safely. Reinvest a portion of your profits to grow your account steadily. Avoid doubling your trades after one winning streak. So again, because you took a win doesn't mean you take another one. Market is uncertain. outcomes are uncertain, price action is uncertain, nobody knows, nobody, not Warren Buffett, not Charlie Munger, not Larry, nobody knows. That's just the truth. No, trading is a reflection of real life. Nobody really knows the next instance. The markets represent a collective uncertainty. I think you should always remember that. Also, is diversify. The moment you start getting advanced, in the beginning, it's expected for you to focus, and hone your skills again. Let them marinate. Let everything you are learning become a part of you. Then eventually you diversify because again, you want to make as much money from different things with as little possible effort. So don't risk your entire account on one currency pair or trade one setup. Spread exposure across pairs with low correlation. Something that traders do in this industry is eventually, as we get more advanced, we kind of realize that trading is trading. It doesn't really matter what you're trading. And trading teaches everybody the same principles, whether you're trading options, stocks, bonds, indices, cryptocurrency, or Forex. We are all eventually children of the same parents. We are just, siblings, So eventually you see people who trade Forex and made success in Forex, learn indices trading, learn stock trading, try to learn commodity trading, and you may find success in one, and this is how you end up diversifying. Market cycles happen such that you may not be able to trade Forex for a couple months, and then you just go to another asset class and you trade and you can profit. So this is the point of diversifying in trading. So obviously in life generally, also very important to diversify. You can't just have stocks, you can't just have bonds. Eventually you want to do some real estate, you might do some physical assets, so that's just the point of diversification in general. So, common mistakes to avoid. One is risking too much per trade. Anything more than 5% is outrageous. Really, it is. It's getting to levels of outrageousness. And again, except you are a professional and you just, it's trading. Again, people try to do things. People try to push the limits. But why are you pushing the limits if you're not yet a professional? Why are you pushing the limits if you don't know what you're doing? Why are you pushing the limits if you cannot afford to lose the money in your account? Why would you put your school fees or your rent or tuition in a trading account and risk 5% or risk 10%? That's outrageous. So people who do this generally have massive reserve funds, and then they just play around it just to see what's possible. They push. But this is not professional. This is not done on a professional level, on an institutional level. This is not accepted. So trading without a stop loss is also not accepted. You must know where you want to exit. The market, I think there is a common quote that says the market can remain irrational longer than you can remain sane. The market can just keep doing nonsense longer than you can remain balanced. Eventually, the market will test you mentally. So, why would you trade without a stop loss? You want to be out quickly and just know that, look, I lost it. Like, yeah, I try again the next day, the next month, the next week. Come again. Again, protect your capital and you can trade again. Protect your life and you can climb Everest again. So moving stop loss further away out of fear. This is one of the worst things that you can do. Why, you already plan to lose the trade, why don't you just take it and lose, they will say, responsibly. So another common mistake you can make is over trading to recover losses. This is a common mistake that people make. It's an emotional mistake, it's a psychological mistake, which is why I tell you that trading really, there's technical side to it, there's knowledge, there is your intellectual side to it, but look, trading is very psychological, very emotional. Trading will test you, which is why this lecture exists, because this lecture is not supposed to push you to trading, it's supposed to help you know if it's something you want to do. Because when you see all these complexities and if you should decide, can I do this? It is emotionally draining. Trading is, combine all the heartbreaks you've ever suffered and compress it into a 5-minute period. That's the level of emotional pressure trading can give to you in a very short period of time. Your blood pressure will spike. Your stress level is going to go over the roof. That is what trading is like, especially when you get started without